Right now, 3.2 million drivers across Britain are about to receive renewal letters that will make them physically sick. Numbers so obscenely high, they'll call the insurance company thinking there's been a system error. There hasn't been. And here's what makes this a genuine crisis. Most of these people think they've just been unlucky, that they picked the wrong insurer, or their postcode got worse, or maybe they forgot about that one speeding ticket from 3 years ago. But the truth is so much darker than that. What's happening to car insurance in Britain isn't random bad luck or market forces doing their thing. It's a coordinated system of extraction, hidden mechanisms, and regulatory loopholes that have turned your legal requirement to drive into one of the most profitable scams in British financial history. And the people running it are banking on you never figuring out how it actually works. Last month, I spoke to a warehouse supervisor from Nottingham named James. 35 years old, clean driving license for 17 years, never made a single claim, not even a parking ticket. Drives a 2019 Ford Focus. Nothing fancy, nothing modified, just a reliable family car. Last year his insurance was $640, perfectly reasonable for someone with his record. He'd been with the same company for 3 years, always shopped around at renewal time, always got decent quotes. This year, his renewal letter arrived. $1,080. Exactly double. He genuinely thought it was a typing error. He called the company and sat on hold for 45 minutes, and when he finally got through to a human being, they confirmed it without hesitation. "No mistake, sir. That's your price." So James did exactly what you're supposed to do. He went on every comparison site, Money Supermarket, Compare the Market, Confused. He spent 2 full hours entering his details over and over into different websites. The cheapest quote he found anywhere was $150, still nearly double what he paid 12 months earlier for the exact same car, same address, same spotless record. Nothing in his life had changed except the number on the renewal letter. And here's the part that should genuinely terrify every person watching this. James is not an outlier. He's not some statistical anomaly that got unlucky. He's the average British driver. According to the Association of British Insurers, the average car insurance premium in the UK hit $635 in the fourth quarter of 2024. That's up from $416 in 2022. That's a 52% increase in just 2 years. But here's what they're deliberately not telling you in those carefully worded press releases. That $635 is the average, which means half the country is paying significantly more. If you're under 25, you're looking at premiums between $1,800 and $2,500. If you're in London or Manchester, add another 30%. If you drive anything slightly more powerful than a shopping trolley, or you've made a claim in the last 5 years, you could easily be paying $3,000 or more just for the legal privilege of driving to work. We're not talking about a minor adjustment to your monthly budget here. We're talking about car insurance becoming the 4th or 5th biggest bill in most people's entire lives, right up there with rent, food, and energy. So what the hell is actually going on? Why has car insurance suddenly exploded in a way that seems to defy any rational explanation? The insurance companies will tell you it's inflation, it's claims costs, it's supply chain issues affecting repair times, and there is some truth buried in those explanations. But they're not telling you the whole story. Not even close. Let me show you the real mechanisms driving this crisis, the ones the industry desperately hopes you never understand. The single biggest driver of soaring car insurance costs is something most people have never even heard of. It's called credit hire, and it's a £2 billion scam happening in broad daylight that you're paying for every single time you renew your policy. Here's how it works. You're driving along completely innocent when someone crashes into you. Not your fault. Their insurance should cover everything, right? Your car gets taken to a repair shop, and while it's being fixed for 3 weeks, you need a replacement vehicle. Seems perfectly reasonable. So a credit hire company, these are firms you've probably never heard of with names like Accident Exchange, provides you with a replacement car. You think it's free because you're the innocent party in the accident. But here's the scam that's costing you hundreds of pounds every year. That credit hire company isn't charging normal rental rates like you'd pay if you walked into a regular car rental place. They're charging what's called credit hire rates, which are inflated by 300 to 500% compared to market rates. A car that would normally rent for $30 a day gets billed to the at-fault driver's insurance company at $150 a day, sometimes even more. So you're driving around in a replacement Vauxhall Corsa thinking everything's sorted. Meanwhile, behind the scenes, the credit hire company is billing the other driver's insurer $150 a day for that Corsa. If your car takes 3 weeks to repair, which is increasingly common with modern vehicles, that's over $3,000 just for the hire car. For a Corsa. Now you might be thinking, so what? That's the other driver's insurance company's problem. They caused the accident. Except, it doesn't work that way. Because what happens when insurance companies have to pay out massive inflated credit hire claims on thousands of accidents every single week? They raise everyone's premiums to cover it. Including yours, including mine, including James from Nottingham, who hasn't made a claim in 17 years. The Motor Insurers Bureau estimates that credit hire fraud and inflated costs add approximately $50 to $80 to every single car insurance policy in the UK. You are subsidising a system where middleman companies extract billions of pounds annually for providing replacement cars at artificially inflated rates that bear absolutely no relationship to actual market value. And here's the most infuriating part. The insurance industry has been complaining about this problem for years. They've taken credit hire companies to court repeatedly. Some cases have gone all the way to the Supreme Court. And the courts have sided with the insurance companies, saying these rates are unreasonable and exploitative. But the credit hire companies just keep doing it anyway because the money is too good. They pay the occasional legal judgment and carry on extracting billions. You, the ordinary driver who's never heard of credit hire, are caught in the middle paying higher premiums year after year to fund a broken system that benefits everyone except you. But credit hire is just the first layer of this disaster. The second mechanism driving your premiums through the roof is even more insidious because it was originally sold to you as the solution that would make insurance cheaper. It's done the exact opposite. Let me introduce you to telematics, which you probably know as black box insurance. When this technology first launched about 10 years ago, it was marketed as the revolutionary solution to expensive young driver insurance. The pitch was beautifully simple. Let us monitor your driving, prove you're safe, and we'll reward you with lower premiums. It sounded brilliant, genuinely innovative. Data-driven pricing where good drivers pay less and bad drivers pay more. Perfect market efficiency. Except that's not remotely what happened. Insurance companies realized they could use telematics data not to reward good drivers, but to identify and reject anyone who shows even the slightest risk factor. They created a system where the technology doesn't make insurance cheaper for safe drivers. It just makes it impossible to get insurance at all if you're anything less than algorithmically perfect. You drive at 11 p.m. on a Friday night because you're coming home from work. Risk factor. You occasionally drive slightly over the speed limit. Literally everyone does. Risk factor. You brake firmly a few times because traffic is unpredictable and someone cut you off. Risk factor. You live in a postcode where statistically more accidents happen, even though you personally have never had one. Risk factor. The telematics system was supposed to measure your individual driving behavior. Instead, it's become a tool for mass risk profiling that punishes you for things you can't control. And here's the real kicker. Once you're flagged as high risk by the algorithm, you cannot argue with it. You can't explain that you were braking hard because a child ran into the road. You can't explain that you were driving late because you work night shifts. The algorithm doesn't care about context or explanations. You're high risk, claim declined, Or if they do offer you insurance, it's at a price so ridiculous you can't afford it anyway. Now let's talk about the third mechanism. And this one is going to make you genuinely angry because it's pure naked profiteering dressed up as regulatory compliance. In 2022, the Financial Conduct Authority introduced new rules called the Pricing Practices Reform. The goal was actually noble: stop insurance companies from price walking, which is the manipulative practice of gradually increasing premiums for loyal customers every year while offering dirt-cheap deals to new customers. You've probably experienced this yourself. You stay with the same insurer, your premium creeps up 20, 30, 50 pounds a year, and when you finally call to complain, they suddenly magically find you a better deal. So the FCA said, no more. You have to offer your existing customers the same price you'd offer a brand new customer. Sounds great, right? Finally, loyalty gets rewarded instead of punished. Except that's not what happened. Not even close. What actually happened is insurance companies looked at this new rule and thought, okay, we can't charge our loyal customers more than new customers anymore, so we'll just charge everyone more. They removed the new customer discounts entirely. The cheap introductory rates that made comparison sites useful just disappeared overnight. Instead of bringing existing customer prices down to match new customer rates, they brought new customer prices up to match the inflated loyal customer rates. The result was catastrophic for consumers. The average premium for new customers shot up by 40 to 60% in a single year. Comparison sites, which used to be a reliable way to find cheap insurance, suddenly became almost useless because every quote was expensive. There were no discounts left anywhere to find. Admiral, one of the UK's biggest insurers, reported a 96% surge in profits in 2023. Direct Line's profits jumped 73%. Aviva posted record underwriting results. These companies aren't struggling. They're not absorbing costs and barely surviving on thin margins. They're printing money, and they're doing it by using a regulation that was explicitly supposed to protect consumers as justification for raising everyone's prices across the board. The insurance industry looked at a rule designed to stop them from exploiting loyal customers and found a way to exploit absolutely everyone instead. So what can you actually do to protect yourself from getting absolutely destroyed by these costs? First, increase your voluntary excess. Most people leave it at the default, usually 100 tolerance or 250 tolerance. Big mistake. By increasing your voluntary excess to 500 tolerance or even 1000 tolerance, you can cut your premium by 15 to 30%. Second, pay annually instead of monthly. When you pay monthly, you're essentially taking out a loan from the insurance company and they charge interest, typically between 10 and 30% APR. Third, shop around properly using at least 3 comparison sites and do it 3 weeks before your renewal date, not on the day it expires. Insurance companies price more aggressively when you're shopping early. Here's the brutal reality nobody wants to admit. The UK job market isn't going back to what it was, and neither is car insurance. You might cut £300 or £400 off your premium with smart shopping, but you're not getting back to 2022 prices. That world is gone. The insurance companies have figured out they can charge these prices and people will pay because you have absolutely no choice. You legally cannot drive without insurance. You cannot get to work without driving in most of the country. You're a captive market, and captive markets get exploited. The insurance industry is counting on you being too busy, too overwhelmed, or too ignorant to fight back. They're counting on you just accepting whatever number appears on your renewal letter. Don't give them that satisfaction.